we're back, traders and investors. I'm Brianna Valesky with Joel Elkanah, and we have Reverend Emmanuel Lemelson on the line. He's the Chief Investment Officer of Lemelson Capital Management. Father Lemelson, thank you so much for joining us on the show this morning.
Absolutely, Brianna. It's a pleasure to be with you guys again. Thanks so much for the invitation.
We always enjoy having you as a guest. So you and I recently spoke after Bill Ackman was on CNBC again talking about how he thinks Herbalife is a pyramid scheme. And so you and I had spoken a little bit about that now. Would you mind sharing with us what it is that you told me and what you think about it?
Sure. Well, when you're investing, Brianna, you're handing your capital over to a management team who become stewards of that capital. And I think you have to look at the character of the management team and the economic prospects of the business model itself. And you have to ask yourself, of course, if a business has really an enduring competitive advantage, and therefore if the future economic prospects look good. And, when you look at a business, you'd want to be able to look at it and say, could I envision this business 10 years from now and what its prospects would look like? And I think anytime you look at a multi-level marketing firm, there's really intrinsic weaknesses. I realize that multi-level marketing is not illegal, but personally, I'm not really smart enough to figure out the difference between multi-level marketing and a pyramid scheme, to tell you the truth. In the sense that if the primary activity of the clients of the product is really to find new clients, and then they become, it creates this sort of pyramidal incentive structure, it's hard to understand where the emphasis is really on the product. So, that obviously is subject to tremendous vulnerability. And, you can bring up Bill Ackman. I think anyone interested in Herbalife stocks probably would only benefit from watching his presentation and the research his team did. It's very costly to the firm, to Pershing Square, to conduct that research. And, I don't think regulators have so much extra bandwidth and capacity that they would be doing frivolous investigations, the FTC and so forth. So, every person has to make up their own determination, but I don't think the future economic prospects for the Herbalife model or even other multi-level marketing business models, they're not the safest use of capital. And it seems pretty evident from Ackman's presentation that, management does indeed appear to be targeting, low-income families and individuals who really don't have in mind the value of this supposed supplement. They really have in mind this idea that they're going to sort of get rich quick, and that's not really what the outcome is for the vast majority of them. And so that, I think, sort of speaks for itself.
All right, Reverend, let's go on talk about some of your current positions. And I know you've been an Apple fan and plan on never selling it. Have you, can you just give us an update? Have you added to your position out here? Are you going to sell some out-of-the-money calls ahead of earnings? Or what's your outlook on it? I think last time you gave me a 150 price target.
Yeah, I think that's still fair, Joel. There's an issue that a lot of people haven't talked about lately in Apple, and it was kind of a hot issue about 18 months ago, but there's sort of a battle between Android and iOS. And if you look at Apple on a forward P&E basis, ex-cash is trading about 12. P&E is 12. But even that's not really an accurate figure because there's generally a consensus out there, even amongst analysts, that, therefore, the calendar year Q4 sales are going to be very, very strong. I personally think they could have sold over 70 million iPhones, which is a very high margin product for them. If they didn't, it probably would have only been because of supply constraints. When you start to factor in that math for the most recent quarter, forward P&E on an ex-cash basis is probably even lower than 12. You've got one of the best run companies in the world. And if you look at the way Apple users use the products, they would not substitute iOS for Android. And the thing about Android is it really has fundamental issues that can't be fixed. So you've got obviously the fragmentation of different versions that all these different OEMs are running on their devices that are not able to be unilaterally updated. And then you've got the further problem where you have a really negative effect between the OEMs, the manufacturers of the hardware, whether it's Sony or LG or Samsung, and the financial incentives of Android, and Google. So these OEMs would always want to have their own operating system. You see that in the rise of Tizen with Samsung. So these aren't really good marriages over the long run. They're really competitive situations with short-term grasp at market share. But that model's been seen before. Let's get as much market share as we can and make no money or lose money. usually those are not good long-term economics. I mean, we talk about long-term economics in Herbalife. But when you look at the way Apple users using iOS, they're not going to switch ever. And there's still a lot of these logical fallacies of it. People say, well, the high-end smartphone market is saturated. That's a logical fallacy because each upgrade cycle every 2 years or so, every 18 months, whatever, you've got a larger and larger install base of happy customers who are going to upgrade. I mean, there's no such thing as a saturated smartphone market when the technology itself becomes obsolete so quickly. So you wouldn't see someone with an iPhone, 3G or an iPhone 4 who wasn't, really anxious about upgrading. So if in fact there were 70 million units sold in the fourth quarter, for example, I mean, we can understand that the install base has grown. In a year or two from now, that's going to be that many more incremental sales. So when you look at, how Apple's using its capital, for every dollar it's reinvesting in its business, its return is tremendous. And you look at these recent statistics at saturation, market penetration in South Korea, Japan, and China, and so forth. I mean, never before seen penetration rates in Samsung's home territory. Samsung's low-cost model that's really undifferentiated in terms of the operating system. Clearly, I mean, Xiaomi and China's going to eat their lunch. That's been happening.
Yeah,
but
definitely.
At the high end,
it definitely
it's an
has been.
aspirational product still, and a brand that with an increasing moat. I mean, it's really fascinating. You can't look back over the history of public markets and find that many technology companies that have this sort of moat and could. I mean, IBM is one example. They've been around for 100 years, but there aren't that many. I mean, Apple could be sort of the next IBM, and people will probably every day wake up and look at Apple's price and say, well, I was too late. I could have got it for half this much 18 months ago. But, that's not really sound reasoning either, because just because you've made a profit on a stock that the price has appreciated isn't a sound argument to say where is it going in the future. So Apple still looks very cheap. Even if it were at 150, it wouldn't be really radically overpriced. I mean, you look at some of the peer group, Netflix or Amazon or something, it's extraordinary forward P&Es and, infinite trailing P&Es. And in the case of Amazon, at least. And it just don't have a tremendous amount of cash, so it has huge value.
Are you looking for the watch, the iWatch, to add to the bottom line in 2015?
That's a really great question, Joel. And I've read a lot about the iWatch, and I understand the importance of and what it's going to do. I mean, this sort of more intimate, personal technology, the need to fulfill tasks that occur throughout the day. They're not really important enough to have a smartwatch or a smartphone to look at that you pull out of your pocket. I think fundamentally it's an incredibly important product. I'm not sure it's going to impact sales in 2015, and I don't know that anybody knows that yet. Could it fail? Maybe. But if anyone could succeed at doing a smartwatch, I'm pretty sure it's Apple. But then again, it doesn't really need to succeed in 2015 for the economics of the company to look really good. It just needs to get its foot in the door. And if it was in 2016 or 2017 that really came to fruition, that would be okay too, because that's really what happened with the iPhone. I mean, I think Apple in its first year sold a very finite number of iPhones, a million units or something. So it's okay as long as they get their foot in the door, and that thing grows year after year. That's really what to look for. I mean, I think if people are coming out saying this is supposed to, displace, iPad sales or something or some other major product category, I don't think that's the goal. I mean, there's a chance you'd feel disappointed, but I think personalized smartwatches and so forth, there's clearly have a huge role to play in the future. And why would Apple not succeed? I mean, who else is there that can execute the way Apple executes? I mean, they execute with beautiful products.
Okay, let's get an update on a few of your other positions. I know you were long Kulik in SOFA, and that stock is just kind of a slow mover here. Any changes in your positions in that issue?
No, we still have our stake, and we started buying it in January 2013, so we bought at a pretty low price. We were buying around $10, and so when we bought all the way up through April 2014. I think the situation with Kulik and SOFA is, again, a lot of cash on the balance sheet and an underlying cash-generative business. The future economics also look good for the thermal packaging business that they'll be moving into. I mean, they've got 6 units deployed already at major clients. It's probably going to be a $4 or $5 billion business in the not-too-distant future in terms of total addressable market. The real thing to be careful there with Kulik and SOFA, and we've been open about this in our letters, the culture of management and the board of directors there probably could be improved. They're executing well operationally, Bruno Gilmart and Jonathan Chu, but there is unfortunately, this incipient culture of rewarding management with stock options, which are, at a fixed price over a long period of time. And, when you have a legacy technology business, not a lot of cash. You've got retained earnings that are growing in the business. And that's going to happen regardless of management's execution. So I don't think that's a healthy culture in terms of compensation for executive pay. I'd be much happier if the board of directors would say, look, if you meet performance targets, not, that takes into account the cost of capital and increasing retained earnings in the company, you would get X, bonus or something. They'd be free to then buy shares in the open market like any other owner of the stock. So I think that's one thing you'd have to look at if you're going to buy Philips stock. We've been very open about that. We think that culture needs to change. At a minimum, we said you need to be buying back shares to counter the dilutive effect. But when you're buying a stock, it's not enough to just buy a cheap stock. You have to buy one again that has really good future economic value, and presumably you're partnering with a great management team. So my hope is that Keyless and Sofa will eventually that they'll expand about the size of the buyback, but that they'll also reconsider how their executive management team's compensated.
Do you like looking at this technically here? I'm looking at all these highs around the 1470 level, 1450 to 1470. You look at it technically at all? Like, man, if this thing breaks out above 1470, I'm buying some more, or are you just you're happy with your stake? You're not paying that much of the attention to the technicals on it.
Yeah, Johnny, I have to confess, I was never able to understand technicals.
Okay, that's a fair answer. Okay.
Yes, I think that there's always this risk of falling into this thinking that the price of a stock goes down, a whole lot of people are confused beta with risk. I mean, and I've never understood the connection. I mean, the price movement of a sliver of a piece of a business, the greater it goes up or down, is not indicative of assessing risk in the business. And I think that what that leads to a sort of strategy of when the price goes down, it's a confirmation that one should sell, and that as the price goes up or even reaches new highs, it's a confirmation that the stock is safe to buy. And I think, maybe it's just out of my own ignorance, but I think it's really the opposite. I mean, I think as the price goes down, if you've got a great company, the risk is lower, and the opposite is true as the price goes up. So I think at the heart of most of these arguments, I think people who look at the technicals, I mean, perhaps they're associating beta with risk, and I'm just not convinced there's any relationship.
Okay, let's talk about one that maybe is not going your way quite as much here. Geospace Technologies Corporation.
Sure.
I know they're involved in the oil patch, so that's been weighing on the issue here. You built a base, at just about at this level. When was that? About a few months ago. Really hasn't been able to mount much of a rally. Are you still supporting this stock? I mean, you had the lows just above 24. You took that out, and then you're building another base here at the 2350 level. So how you doing on this one?
Yeah, great question, Joel. We added to our position, I think, since the last time we spoke. I don't remember our last interview, but we did want to, we initially started with buying about 2% of the company, and we started buying more. It's surprising just how low it's traded. I mean, at 23.50, 24, you're below tangible asset. Geospace is a great company, and it's an interesting company. First of all, their CEO, Rick Wheeler, is first rate, and his whole management team. I mean, on the spectrum of executive management out there, these are the guys who want to hand your capital over to these stewards of. They're down to earth. They don't have their hands in investors' pockets, like you might see in some of the other companies we've written about in the past, Ligon and so forth. If you look at what we talked about, how that company was handling not just the nature of news it was selling to its investors, but how it was really fleecing its own retail investors, especially. In the case of Geospace, I mean, you've got an operation down there that is really a victim of an extraordinary decline in commodity prices of oil. And the underlying thesis is, do you think oil is going to recover, or do you think this is it? And if you look at the infrastructure globally for, fossil fuels, it's not something that can change overnight. I mean, just pull up to a gas station. There's an infrastructure. I mean, fossil fuels will decline in the future, but it's probably a 20 or 30-year process, at least, for it to be materially lower. And in that time, you just have to ask yourself, are these concerns going to engage in E&P, exploration and production? And the answer is yes. I mean, because oil's run out of the well. The wells run out of oil, excuse me. And if you look at what happened, I mean, people get really worried because, OPEC is not, stop pumping, and shale producers appear to be in a sort of, stand off with them. But that's exactly what you would want if you had a company like Geospace that was producing the tools to make sure that wells are more productive or more efficient, or that new wells could be found. If you look at the companies, take for example what they're doing with their permanent well monitoring systems. I mean, their Statoil contract for $71 million really accounted for only 2 of Statoil's 7 major fields. They pulled that order off beautifully. Just another 5 fields. Just Statoil. I mean, forget Exxon or Chevron or BP or Total or any of these companies. If they implement these permanent well monitoring systems, which is a paradigm shift in the industry, anytime in the next couple of years, we're talking about probably, 700 to 900 million in orders from just one concern. You go down there, though, and you look at the stock at $24 a share. I was in Texas just a week and a half ago, having lunch with Rick Wheeler, the CEO, and you look at the business. You couldn't replace that business for its enterprise value today. And so you look at that and you say, well, it's probably a significant margin of safety because it just takes a couple orders. I mean, you don't even have to have huge orders. Look at their install base already available, the access and their wireless ocean bottom system. They've sold over 400,000 of those things or put them into their rental fleet. And all you're really betting on is that fossil fuels are not going away. And your margin of safety is you've got hundreds of thousands of square feet down there in Texas with, an incredible manufacturing operation. And the business is not exciting enough technology to attract a lot of competitors. I mean, they're not making smartphones. There's not going to be all sorts of ambitious Chinese companies saying, let's make geophones and, wireless monitoring systems. But at the same time, they've invested enough in R&D that they are the clear leader. I mean, nobody disputes that. So not a lot of competition. And so they're in an interesting place because they're small and they're not really working on a really exciting product that's going to, explode. So they're not attracting a lot of competition. And then you see, a business that its replacement value is much, much higher than its value today. So, in our last call, I talked about a 2-year time frame. If you're committing capital, it's a little bit of a special situation because you look at it right now and you say, well, it's tied to commodity prices. It's true. But overall, the economics of the business have been very good over many years. And coming out of no debt, a significant cash position. It may take some time, so I'm not saying this thing's going to turn around in a year, but when it does turn around,
keep an eye
I think
on it.
Patience will be well worth it.
Yeah,
I really do.
I was just looking at this thing, and just technically, it's just winding up here. It had a big move coming off those lows, and boy, I tell you, if this thing can get above the 2650 level here, call a lot of highs in that. I'd look for some more continued upside in that. Okay, Reverend, we're just going to let you go here in 1 minute. Chief Investment Officer, Lemelson Capital Management. Any final words of advice for investors?
Well, people always want to know what's going to happen in the markets, and I don't know, but, the future, I don't know tomorrow or next week. But just I would say be very careful because markets have risen now for 5 years, and a lot of that rise in share price has been a result of things like QE. And obviously, it was big news this last week with what happened at the ECB. And, this sort of artificial stimulus, what could be called printing money or monetizing the debt, that sort of thing. And it leads to low interest rates, which always leads to greater borrowing in markets, especially marginal loan borrowing. And huge markets like China and so forth, certainly, and the U.S. for that matter, a big part of the capital going into markets is low-cost borrowed money. And what's become an overall ubiquitous share repurchase mentality in public markets. So you have to ask yourself, are markets rising because fundamentals are really good, or are they rising because of these other factors? And are these other factors sustainable in the long run? So, I just always would say be very careful. I mean, inflation is going to happen, and inflation is good for assets, and the wealthy that own assets is a source of wealth. But if you're an investor, be very cautious and always look for securities where you've got a significant margin of safety, but even more so where companies have very, very long-term favorable economics.
Okay.
Because sooner or later, markets will decline.
All right. Reverend Emmanuel Lemelson, Chief Investment Officer of Lemelson Capital Management, discussing his positions in the market, his outlook for the market. We appreciate having you on, and we'll talk to you again soon.
Thanks, Father Lemelson.
It was really a pleasure. Thank you so much, Brianna and Bill. God bless you both.